Welcome to this week's 5 in 20. Hey, Brad.
Hi, Casey.
We're going to cover 5 topics in 20 minutes. And why don't we just get started? Minimum global corporate tax rate. I saw this in the Wall Street Journal. I guess it was earlier this week. That was an interesting article. The theory here is that the U.S. right now is going to 32 countries and saying we want there to be a minimum global tax rate set. We all need to agree upon it.
It's an interesting idea, but everybody's economy is set up slightly different than everybody else's, and then their need for revenue is different from everybody else's. And getting all these countries to agree to a single number is, in my opinion, just going to be very difficult. So I wonder if there's another reason for this.
Internally, inside your own country, they're trying to set a floor. They're saying you can be higher than 20%, but you can't be lower than 20%. To me, that was the whole point of competition. I mean, no, we don't want to lose jobs overseas. And I think that's what they're concerned about. I think the Biden administration is concerned that by raising the minimum corporate tax from 10.1 to 20%, that they're going to end up in a situation where they start losing jobs overseas. And then, in a interview, Biden said, "Oh no, there's no data that supports that. Yet we have Yellen out pandering this minimum global tax because she wants to protect the U.S. economy from job loss."
Well, I think she's right in doing that, and I think that they're floating. It's kind of, what do they call it? Floating an air balloon up there and saying how this is received by the rest of the world.
Right.
Gives the administration some cover should it not be received very well. So.
Well, in the end, I don't think that it works because we're not signing a treaty with all these 30 plus countries. We are simply saying, hey, yeah, minimum corporate tax rate, but they can do whatever they want to in the end. So I don't think it has much legs, but it just kind of caught my eye of, I thought free market capitalism was all about, pricing things where you wanted to be priced so you could get the work or the business. So,
well, we'll have to see where this one goes. We're going to take care of our own tax structure here in the U.S. I know the administration is going to make a proposal here very soon, and we'll just see how that's received internally and how Congress, views it, what they think they can work with, and what they think they want to change.
Yeah, I agree. All right, Brad, we can't get rid of GameStop out of our weekly updates. Why is this?
The name recognition and the notoriety of this company has just skyrocketed, like the price of their stock skyrocketed.
This is the Blockbuster of video games. You can buy video games Walmart, Target, anywhere online for that matter. In fact, I think most consoles, I'm not a video game expert, but most consoles, you don't have to go anywhere. You can just download them to the console and start playing the game. There's even subscription services now. You pay so much per month. You can play almost any game you want to for a monthly subscription all through the cloud. You're not even really doing it by having to go to the GameStop. So I just thought it was interesting that GameStop is going to issue more shares. They have about $508 million in cash now. Their year-over-year sales growth is up 11%, which I thought was interesting because I think they're taking advantage of all this mania surrounding their company when it really has nothing to do about their company.
Well, that's right. They're branding, they're rebranding, I guess is a better way of saying it. Their company name, and they're utilizing all this public information that's occurring out there, and they're taking advantage of it. And I certainly applaud them for that. If they can get more investors to put in more money, they can work on the transforming their company into a more digital age, and compete with some of the larger companies out there, Electronic Arts, Activision.
Yeah. But I just wonder. So the whole premise of GameStop was you had a rogue group of investors that were able to motivate other people to go out and invest. They went out and invested in GameStop because they wanted to hurt the elite investors inside hedge funds who are shorting the stock. So you have a short squeeze. We've talked about that. We have a whole podcast on that. So they want to create this short squeeze, which drives up the price. They make a lot of money. Well, they did that. They drove up the price from $16 to I think it was around $483 on January the 28th. 3 weeks later, the stock was back down to $39. So it has nothing to do with the company. It was just this movement that was out there trying to hurt some investors, and it did. I think it almost took down one hedge fund, but then there were other hedge funds who profited greatly from it. So the net was probably hedge funds, if I had to guess, in the end. But when you issue more shares, what's going to happen is you would have a price reduction because there's more shares on the market. There's your price your revenue per share is now diluted, right? So all the rules to investing, are they out now? That this doesn't matter anymore because now we're just in this mania where I think in the last year 95% of stocks are all up.
The investors who are into this company right now aren't buying the fundamentals of the company. They're buying the story. They're buying the brand at the moment. And the company is right in taking advantage of this and trying to raise some money. They've reconfigured their management team. They've reconfigured members of the board, brought in more online savvy business people, and they want to raise some money to see if they can, make this transition from a traditional retail outlet to an online outlet, it would appear. So I think they're doing all the right things. They're taking advantage of the moment. They brought in new people, and they're going to raise some money.
So the organization is doing a great job of taking advantage of the situation. There's still going to be a lot of people hurt. Probably people who borrowed money to then invest in GameStop. Those are the people that get hurt in the end. So I don't think the story's over. I think there's already a movie deal about all this, which is crazy. Let's go move on to an interesting topic. China is creating its own digital currency. It's the first major economy to do so. Very long, lengthy article in the Wall Street Journal. You should read it. You think about digital currency, you think volatility, you think Bitcoin, you think XRP. Here is a state-run government that's creating their own digital currency. In fact, they're testing it. It's an app. The app looks like their currency. It has an image of their currency on it. And they're giving people money, and then they're telling them to go spend it. So they're going out to, I think they even can use it at some of the American chains. I know McDonald's was taking it now over there. There's no $15 conversion fee. The conversions, I guess, are inexpensive or free. And I think the world should take note of this. I think this should be a big concern to the American dollar long term.
Well, they utilizing this new technology in order to affect transactions within their country. They think that they can get some traction on this and protect the yuan, from outside influences. Being able to track the usage of the electronic yuan helps them to understand where the people are spending money and how they're spending it and the rate of turnover of spending of that money. It's interesting, kind of on a bizarre side note, is that the Chinese were the first ones to utilize paper currency.
Yes, that's right.
Yeah. So here now they're trying to be the first ones to utilize an electronic currency that's actually sponsored by the government. Whereas here in the U.S., we're looking at the Bitcoin and some of these others, and they're not sponsored by any government agency. They are freestanding fiat currencies at the moment.
That's right. So right now, 88% of the world's currency is
the
transactions are in U.S. dollar.
Right.
I think like 5% or so is the Chinese currency. What's going to be interesting is how they use this to get around sanctions. So right now, first of all, with this new digital currency, they don't have the volatility that Bitcoin would have because they're just setting the price themselves. So they eliminate the volatility. So now they have a stable digital currency, which is valued really closely or the same as their paper currency. That means that if they want to transact things around the world, they want to receive money, it could be put into that digital currency and transferred pretty much anywhere in the world is what they're trying to do. The U.S. can't track that. All the foreign transactions, I think they go through SWIFT, and so the U.S. can see where money's flowing, right?
Right.
You can't do that with digital currency.
No,
so they're able to
avoid
to avoid sanctions. So that could really unleverage the U.S. and their ability to hurt China for the things that they do.
Right. Well, it's kind of a test case. The world is watching.
Next topic. This concerns me too. I think you've read some articles about this as well. But investors are borrowing more money than ever, big and small investors, to invest in the stock market, and I think that's very dangerous. It's kind of shades of 2007, if you want to look at that, or even possibly even 2000 with the .com bubble. But we're able to see, or FINRA is able to see how much margin is being used on an account. So when you borrow money on a stock account and the markets go down, there's a certain percentage of your account that can only be margined. So let's say it's 25%. If all of a sudden your margin goes up to 50%, you now have to cover 25% of that account. You have to add more money to that account, or you have to liquidate positions. So what I'm concerned about is if we're having more and more money being borrowed, that we're also going to have more volatility. Because if we have a correction, a small correction, which could be healthy, even if it's just 10%, people who are over leveraged will have to sell more, which causes more downward spiral potentially.
Right. It creates additional volatility in the market that wouldn't otherwise be there. You had alluded to the 2007, 2008 great financial crisis, which in some part at least was caused by people borrowing money against real estate. And they kept levering up and up and up and up because real estate kept growing and growing and growing and growing. It was thought that real estate is a safe investment. These are real gains that should stay in place. As the real estate market did turn downward, people were forced to walk away from those real estate properties or forced to sell them at a lower price. And the selling created additional selling and so on. We slightly alluded to this idea of margin when we were talking about GameStop, where people are borrowing money to buy the stock in order to participate in these price movements. The thing about borrowing money to buy stock, it levers you up where you can buy more and more and more stock, and that generally raises prices. But when prices turn over and the stock prices begin to decline, the selling that goes into effect in order to cover your margin calls from the brokerage firm creates additional selling and additional selling and additional selling, which drives prices downward. So it really has an effect on volatility over really can be short periods, because on the sell side, the sell forces other people to sell to cover their margin losses as well. So it's a very, very difficult thing for individuals, I think, to utilize margin in a proper way in order to buy more stock. It could be that some of these people are taking money out for other purposes because they've seen such high increases in the asset values themselves. But nonetheless, regardless of the purpose of that money, should the price of that stock, which is being held as collateral in the account, begin to go down, that brokerage firm that loaned the money is going to ask you to bring in money, or if you're unable to, they're going to force you to sell stock to do so.
Yeah, I would argue that nobody should be borrowing money to invest in the stock market, even your primary home. I know that that's a very popular recommendation is to take out a cheap mortgage, pay the mortgage, and then invest that money. That to me that's not sound investing. If you want to do that on second and third properties, that's fine, but your home should be paid off, especially in this environment where nothing is really running by textbooks anymore. All the stuff that we've learned and told was true isn't always true. So there's additional risk out there. You should have your home protected. The stories of borrowing to buy, putting all your money in GameStop was very saddening to me. Let's talk a little bit about a report that came out recently. You won't believe this, Brad, but I've read that politicians might be using insider trading through congressional meetings to benefit themselves. I know you won't. I know you won't believe that.
No, say it isn't true, Casey.
I thought it was a little distasteful for the politicians to walk out of that Senate meeting over a year ago and then liquidate their portfolios because they just got the first image of COVID. Yet to go to a microphone and say everything's going to be fine, it's not going to really affect us, when clearly they thought it was, because they liquidated and they bought stocks related to pandemics. By the way, every one of those congressmen and congresswomen were cleared of wrongdoing. So despite maybe it being kind of a distasteful move, everything that they had at that point sounded like public knowledge. We all could have figured it out. So it was not insider trading. All cleared. The last one was cleared.
But one of the interesting points there, I don't mean to interrupt, but they're being investigated by their peers,
yes,
who are apparently participating in these same types of activities.
Many of who were also Democrats. So you think the Democrats would pounce on the Republicans in this case, and they did. They did in campaigning, which is kind of a free for all these days. But what I found interesting is that those same Democrats are also doing the same thing. So it's the pot calling the kettle black in this scenario. So they're all doing this. In fact, that's what this report. It was published by RIA Intel. That's what this report goes and shows us, is that especially the state and the state level, which there's more politicians at the state level than there are at the federal level, because obviously there's more states, right? But the state level and then the lobbyists are also doing the same thing. So
and the staff members.
Yes, right. Staff members.
For every elected official, there's a staff.
When you track the trades of politicians and you look at the stocks that they purchase in their local states, those stocks significantly outperformed what other people would normally have in their portfolios. And if you look at it from a national standpoint, their portfolios tend to always outperform. And that's because they're in congressional hearings and they're getting investment ideas and they go out and they execute that. So I don't know. I mean, there's a Brad solution to this. I want to know what the Brad solution is to this.
Well, if somebody has raised their hand and they've said, elect me and I will go out into the political arena and the governing arena, and I will going to make decisions that I do not benefit from. I'm going to be a fiduciary, we'll call it, for the people I represent. Any decision that's made on my behalf as a result of the occurrences that we make decisions on within the political arena I should be unaffected by. But the only way to do that is put all the assets into a blind trust that's managed by somebody else that you, as a politician, do not have contact with during the period in time that you're in office. Some of that is probably occurring. I would guess that many politicians do that, those that have significant resources and assets. Mm-hmm. Some of it probably, though, although it isn't occurring, and some of it is probably occurring, like after the fact, there's probably phone calls that go back and forth. So it's not just putting the assets in a blind trust. All communication should cease with the advisor. And the way the advisor can protect their client the best is to utilize broad-based index funds. That way, there's no finger pointing saying you bought X company stock shortly before or shortly after you made a decision in governing your local or statewide or federal position that affected the company in a positive way. So communication should be cut off, index funds should be used, and everything's put in a blind trust managed by a third party.
Congress legislated the target date index fund, which they think every 401k should have. So maybe we just put all their money in a target date index fund. We'll give them the doubt. We'll give them some of the best ones. We'll give them the Vanguard one or maybe a T. Rowe Price one. But maybe they should just all have target date funds. No individual stocks are allowed, and maybe that cleans things up, or at least it it makes them focus on the big picture, right?
I would think they'd want this because these are nuisances where
right.
They get a phone call from a reporter and they're like, "What? I had nothing to do with that."
Maybe that actually prevents other people from running because they wouldn't want to do that. But I don't know. It's not surprising, but if you're a Republican, you should complain about the Democrats doing it. If you're a Democrat, you should never complain about the Republicans doing it because according to the study, every one of them does it.
And it's been happening for a long time.
All right, Brad, good topics.
You bet.
Talk to you later.
Great.